In case you didn't know, compound interest is magic. Hi, I'm Liz from Liz Gets Loaded. The money kind of loaded, though I do drink wine while I record these. Let's see if I can retire in 5 years, shall we? Now let's get one thing straight first. You should probably be careful taking financial advice from someone whose username implies she might be drunk. I'm on the path to FIRE, that stands for Financial Independence, Retire Early. I prefer the term work optional because I like working and I probably won't quit even when I have enough money to retire. Today we're talking about paying off your mortgage versus investing in the stock market. If you're with me so far, hit that thumbs up button. It helps me out and it makes my day. Now, first things first, when I first started looking at my finances more seriously, I focused on two things. One was paying off all of my non mortgage debt. Two was maxing out my tax advantaged accounts like my 401k, IRA, and HSA. But once that was done, I was like, then what? I figured with any extra money I had each month, I had a couple of options. One, I could pay extra towards the mortgage. Two, I could invest in a taxable brokerage. I might invest in real estate. Maybe look at some options like crypto, peer-to-peer lending. I could even start a business. Or look at other things that I don't actually know as much about, like annuities or whole life insurance. These last three weren't that interesting for me, and I think most people tend to look at the options of either paying extra towards the mortgage or investing in a taxable brokerage. So let's take a look. Starting with paying off the mortgage. Now, a big advantage here is that it's pretty low risk. When you pay extra on your mortgage, you know exactly how much interest your savings, how much you're going to cut down on your overall mortgage payment. You know exactly what's going to happen when you pay extra on your mortgage. And for some people, the peace of mind of having a paid off house is absolutely priceless. On the other hand, investing in the stock market brings higher risk. We can look at the past and know historically what annualized returns have been and predict what we think an average might be, but the truth is no one really knows what's going to happen in the stock market. But with that higher risk also comes potential higher returns. So let's take a look at three examples. Example number one, if you have $500 extra a month and you pay that $500 towards your mortgage. Option number two, you take that same $500, you pay $250 extra on the mortgage, and then invest the other $250 in an S&P 500 index fund. Option three, skip making any extra payments to the mortgage and just put all $500 straight into the S&P 500. A couple details to keep in mind on all of these three examples. I'm assuming a 30-year mortgage of $500,000 at an interest rate of 3%. I'm also assuming that this person is going to make the same decision every month. And I'm going to go with a 7% rate of return in the stock market. Now I'm thinking about the S&P 500. Historically, the returns have been closer to 10%, but I want to be a little bit more conservative here. So, example number one, you put $500 extra towards your mortgage, and then once the mortgage is paid off, you keep using that $500, but instead now you're putting it into the stock market. So after 30 years, you'll have a paid off house, woohoo, and you'll have $33,000 in your investment account. That's a pretty good deal. But let's take a look at example number two. So remember, in this example, you put $250 extra towards your mortgage and invest the other $250 into the stock market. Once the mortgage is paid off, you put all $500 into the stock market. After 30 years, you'll have a paid off house, nice, and $303,000 in your investment account. And lastly, example number three, you put $0 extra towards your mortgage and you invest $500 into the stock market each month. After 30 years, you'll still have a paid off house and you'll have $606,000 in your investment account. Now let's recap. Example number one, example number two, and example number three. Now remember, in all three cases, you end up with a paid off house at the end. With number one, you have $33,000 in your investment account. Option two, you have $303,000 in your investment account. That's 10 times the amount. And example number 3, you end up with over 600 grand in your investment account, double even option number 2. Now, I know which one I would pick, example number 3, but personal finance is personal, so you can always do what feels right for you. If you like this video, you can like, subscribe, or leave a comment. A nice comment. You can also find me on Twitter and Instagram at LizGetsLoaded. Thanks, friends, and I'll see you next week.